Okay, after breaking out last week, after a really important week, jobs and earnings and FOMC, we didn't really follow through on that this week. We had a good start with the Powell speech, but since then, not really building on that breakout and setting us up for an important week next week with what's expected to be a stronger inflation report, is setting us up for a fake out pattern. So I'm going to show you kind of some signs I'm seeing there, especially across a lot of other indicators that are kind of suggesting reversal in this next week. So I'm going to break all that down. Some major asset classes that are kind of driving this move of risk aversion. So we'll take a look at how dollar and bond yields are doing and things like that, as well as some of the riskier asset classes like the ARK investment types, the meme stocks, Bitcoin. They're all kind of telling us some interesting things right now. Sector rotation, especially in some of the cyclical areas, there's a significant rotation going on. We'll look at that, and then we'll take a look at one of those types of stocks, and it's pretty significant reversal, and we'll talk about how to trade it. So let's go ahead and get started. Today is Friday, February the 10th, 2023. This is the market outlook from MarketScholars.com. My name is David Settle. All right, before we get going, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button. Hit the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our chart links that we have for everybody, as well as a new feature we have for our premium subscribers to be able to chat with each other through a private Telegram channel here. So come down here, click on this heart, it opens up this tab, hit that like button. Same thing here, click on that thumbs up icon, it opens up this tab, hit that like button. Again, the more you do that, the more you like and share and retweet and comment on our posts, the more our stuff gets out to all of our followers on those platforms. It really helps us out to get our word out. So we appreciate everybody who does that, and ask if you got a second right now while you're watching, go ahead and make a couple clicks there, and that will go a long way for us. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. And you can see the S&P finished the week on a little bit of an up note, up 9 points, 0.25% of staying above 4,000, of course, almost getting back above 4,100. Intermediate line is falling, but stayed above 80 to finish the week. The market sentiment line is still falling, and it's actually kind of picking up the pace of its decline. And almost is back out of markets bullish territory. Short-term sentiment followed the momentum line down. It's oversold, not dramatically oversold, so it's not at strong bearish levels, not like it was over here. It was actually a lot more bearish at the lows of the day. But the nice little rally there kept us above, kept us out of that reversal zone. You can see we stayed at 2 1/3% above the 30-day moving average. You can see the even more bullish on the Nasdaq, the Dow is barely above the 30-day moving average. You got light pink shading there as the intermediate line is below the 80th percentile and dropping, and you can see its market sentiment lines easily dropping as well. The Nasdaq 100 a little bit more bearish of a short-term sentiment, as you can see, a little bit more bearish of a day as well. We actually finished down. But the intermediate line is still above 80. Market sentiment line is actually falling just barely, but it's in neutral zone, and we're almost 5%. We're way up above the 30-day moving average, as well as the Russell 2000, well above 2%. But its intermediate line, its short-term sentiment is the most bearish. Had a really down day on Thursday, and then the intermediate line has dropped below 70. So you can see the reversal, and you can see kind of the weakness developing in these indexes. Looking at the weekly version of the market forecast, you can see again kind of we're holding those important Fibonacci levels. Very similar week coming after this breakout week on January 30th week that we had on this breakout week on August the 8th. We had we weren't able to build on that breakout. Again, very similar environment too, where the near-term line exceeded the momentum line, stayed up where the momentum line was already dropping. Same thing here. And then now your momentum line's falling to levels that you would expect the near-term line to follow suit. And if it does follow suit in the next week, similar to what happened here, if we get below these lows next week, this low of the breakout week and close below that low of next week, then that would obviously lead to more expectations of bearishness. Obviously, you'd be either at or below 4,000 in that environment. Looking at the NASDAQ 100, very similar situation here. Long upper shadow here, a little bit of a longer upper shadow. Again, very similar. You can see the Harami pattern forming and very similar pattern developing as well on its short-term sentiment. On the weekly, again, the Russell 2000, even more significant Harami, again, very similar to the August 8th, August 15th week. So you can kind of see the signs that we might have this past, not this past week, but the week before might be as much of a fake out as August was. The Dow is just not. It was so bullish to get to this point. It's been so flat since, and you can see the near-term line and the momentum line both moving lower, with market sentiment still in bearish territory here. This is not able to really get going. So very, very sideways. Not really going down to the downside either, but not building on that really strong bullish 7 or 8, 9 week period that we had there, where it really took off way more than any of the other indexes. Got above the August highs during that 9 week period. None of the other indexes did, right? The SPX coming off of that low over that same 9 week period here, you can see didn't even come close to getting above. In fact, we got up to higher highs this go around, but that's potentially the fake out. That's potentially the problem that we have here. Looking at the other weekly chart on this, you can see again we got a higher close, barely, but we got a higher close. As of right now, it would be a lower close because right now we're opening at 40.77, and right now we're at 40.90. So this week could potentially be the transition week that especially with the differential breaking below its moving average. We came close to a crossover there that we might actually get next week, depending upon how we end up finishing the week. NASDAQ looks very similar, not as close to the crossover, and again a higher close, but a lower high, showing a sign of weakness there. Remember, the Dow has been so sideways for so long, that it's gotten, you're not really getting. You got the lower high point, but you never did close below this body to really get the reversal. But we're not taking off either to get going, and you can see the differentials really flat as we got very neutral candles, basically setting up for some kind of reversal pattern. Finally, the Russell 2000, we did get the crossover in the Russell 2000 here, but you also did get a lower close. Not only did you get a lower high, but you got a lower close. Remember, that was the most bearish week. When you look at the regular candle here, it was actually a pretty bearish Harami pattern. That's a pretty significantly bearish, because those are two pretty decent sized bodies, relatively speaking. All right, now let's take a look at some of our other oscillators. Again, we've been having 3 green arrows. Obviously, we don't now. We have red arrows, 2 red arrows across the board. We don't have 3 red arrows, so we're still above the moving averages, but we're in a little period of weakness here that needs to pretty much end relatively soon and get back to 3 greens if we're going to maintain the bullishness. I mentioned that we are the stochastics, that orange line's way up here, and we're below that average. So we are in kind of bearish levels from that perspective. The hull finally turned bearish as well, as you see a pretty decent sized candle that broke below the 2.5% mark down here. So it's a pretty decent sized candle that can start a bearish move. The hull just turned bearish. The parabolic SAR had turned bearish a few days ago. So you have all the signs here, and your PPO is below its moving average. So you have all the signs here of bearishness on this particular chart. The McClellan oscillator also turned down, and you can see on Thursday it dropped below the -35 mark, -47 and -43 again. So we're losing some some breadth from that perspective. The money flow is broke below 50. That's a bearish sign for the index. Of course, some of these other oscillators, the DMI, the positive still easily above 25. It's not above 30 anymore, but at least it's above 25. The negative still hasn't crossed above 25 yet. Looking at the Ichimoku cloud, we still have a positive trend. We're below the green line, but we're still above the blue. We're still above the cloud. We still have a positive rate of change. we still have a positive trend. Even though it's weakening, it's still a positive trend. So we're not, it's not like we're tanking here in the least bit. Looking at the Bollinger Bands with the Keltner channels, we are still in the upper half of the bandwidth. We're not in the upper quartile anymore, and we're not above the Keltner channel. We only got above the Keltner channel the 2 days there. One day flirting with the top of the Bollinger Bandwidth with the most momentum down there at the bottom. But now you can see we've been losing momentum the entire time. And like I said, not in the upper quartile of the bandwidth anymore. And the bandwidth is shrinking down towards the lower end. So again, setting up for some kind of squeeze type play on that. Looking at the intraday move, you'll notice that the intraday move, it did get a lower high and a lower low, but we finished above the low on Friday, and we're still pretty much flat for the week, still pretty much in the range of this Wednesday, Thursday 2-day run. So we're not breaking down. The green line is below 70. We've already hit 0 on the red line, so we are set up for a move, and you can see the trend line break there. So we are set up for something to be bearish. We're just not, getting that now. And as I mentioned, it was a small move on Friday, being well below the average on the ATR, 3.5 points and 70 million, which is also below the average. Those are really, really low numbers. 3.5 points is well below the 6-point rate of change, 6.33 point rate of change. 70 million is also well below the average. So these are all low numbers, not low enough to, again, to signify a breakout, but low enough that we're not building on Thursday's weakness, which was actually a much bigger range, 8-point range there, so above the average with pretty decent volume from that perspective. Finally, let's looking at the VIX. The VIX did jump up above 20, so we closed the week up above 20 in one of our first bullish weeks that we've had in a while, right? We had one there, but other than that, it's one of our first bullish weeks we had in a while. We're still pretty low on a relative basis, but it's the VVIX that had a much bigger week this week, one of its bigger weeks, getting above 95. That generally leads to more volatility in the VIX, as their correlation now is back up to 83%, 84%. So you can see the VIX is setting up for a move to the upside. You can see we've been so bearish, so far below its 200-day average, and you can see now, breaking above the 30, and now sitting at the 50 and trying to figure out whether it's going to get above the 50 and start filling in that gap up towards 25 or not, which obviously would lead to more bullishness. Again, saying very similar to what we saw here in August, coming off of that fake out move, and for that matter also coming off the fake out move at the end of March, beginning into April as well. All right, now taking a look at what's driving this action, you can see we had been in this kind of weak dollar move that's really propelled international equities up, and the gold and bonds were all up to the upside. But if we just take a look at what happened here this past week, let's just go to February here. We'll come out to the 10th. If you look at what just happened this past week, it's the inverse. So the dollar was up, and that put pressure on bonds. It put pressure on U.S. equities more than international equities. And you can see commodities really took off. So again, this is not what we want to see, right? Commodity prices rising again, as that's inflationary, and that's the problem. In fact, that's the problem right now, going forward right here for the Fed, is that, or for the markets, is that expectations for a strong CPI are out there. This is the next meeting, and right now the estimates are for 0.5%. But just to kind of give you an idea, this line right here is 0.5%. We don't typically get 0.5% moves normally. So that's a very strong that's a pretty strong annualized rate. And we're expected to get a couple of months of those rates or higher. We could surprise to the upside. So that's the problem right now. And a lot of that, is due to what's going on with commodities. This was a risk-off week, as you have the dollar and gold do well. The only thing, like I said, it didn't do as well in the safety trade was real estate, and which has been linked to these kind of long duration trades. The safety trades didn't do as well either. Long-term bonds especially was down the most. But again, that's a function of yields moving up, and that's again probably one of the biggest reasons why, besides the strength in the dollar, which had a good week, and now is above its 17-day moving average for enough time that they both have crossed, the 8 and 17 have crossed above the 30. The dollar's flirting with getting above its 50. But if you look at TLT, it broke its 50, right? It's really broken down. TNX has gotten up above almost a 3.75%. So it's easily moving higher here as its 8 and 17 are moving above the 30 as well. So things are changing in regards to the dollar and bonds. And that's impacting things like Bitcoin, right? And these kind of higher end risk appetite moves, like as Bitcoin's dropping, ARK Investments has been dropping pretty sharply below its 17-day moving average. So, it appears that these kind of meme trades, are rolling over and aren't nearly, Bed Bath and Beyond, sorry, aren't nearly as bullish as they were. So, we had some strength in the meme stocks. We had some strength in ARK Investments and Bitcoin during this dollar weakness, but now they're all giving back that strength, and it appears we're starting to lose strength across the board. Looking at the sector comparison and how it moved here this week again, and a pretty much widely accepted risk off week here. You can see energy did well with a jump in commodities, especially here at the end of the day on Friday, up almost 5%. Technology kind of matched the market down 1% for the week, but you also had, again, real estate's down, the materials, discretionary is down 2% for the week. But XLC, which is, again, Google, Netflix, Microsoft, those kind of companies, down 5.5%. So really, really moving lower. You can see what their charts look like when I pull up their 12 grid here. You can see XOK, XOY, and XLC up here at the top, but XLC really breaking down more than the others. It's, XOY doesn't have a strong market or intermediate line either, but really breaking down there. There's energy bouncing up, but everything else is kind of working back towards its moving average. You got light pink shading in the yellow line on materials, which can turn into a bullish signal or be the beginning of a reversal. Utilities, staples, healthcare are all in dark pink shading and red line. So in fact, utilities got a cluster, an oversold cluster, like energy did, like staples just did a couple of weeks ago. So, you're not getting a lot of oversold clusters here lately. You did on XOK back at the end of the year, beginning of January. Same thing with XLY. But XLP's and XLU's cluster came on Thursday. XLP's cluster came well after the beginning of the year. So you can kind of see those areas that the money is shifted towards XOK, XLY, XLC. But the issue with that is, and here's the FANG stocks, how they're doing over the last, on a daily basis, over the last 4 weeks. You can see they're all moving down to the left. And if I were to change these to the sector moves, they're all these cyclical areas are all moving down to the left. Energy, industrials, financials, healthcare and staples, utilities as well, or healthcare, staples, financials, and there's energy, and then industrials and staples, healthcare. All of these are moving down to the left there. Let's see. This one would be energy. No, this one would be XLP, XLV, XLF, XLB. Yeah, that's XLB materials. And what's moving up to the right is XOK, XLY, XLC on a weekly chart. But you can see on a daily basis, they're starting to move down to the left. And all these other, especially the safety, XLP, XLV, XLU, they're all moving up pretty quickly. And they had some worse relative strength, but they're now gaining momentum along with industrials, financials as well. So you see the shift and rotation out of those FANG names that have done so well lately as we start to show some cracks of weakness here. So my trade idea was on Wayfair. Wayfair really, again, kind of linked to these ARK Investment reopening trade, a lot of these kind of internet type companies. Wayfair really struggling. Its intermediate line almost breaking down below its market sentiment. Very bearish short-term sentiment. Pretty significant drop here. Obviously not breaking below the 30-day moving average, but definitely breaking below the 17-day and rolling over with the MACD and stochastics both dropping from pretty high levels. Pretty decent gap in volume here as well. Looking at some of the oscillators, you can see the whole really turned down. Big time turn down there. You can see how big that PPO is, and again, very bearish candle, one of your biggest candles that you've seen since August, and that started just like the fake August fake out move there. It started a protracted bearish move when you had that big of a candle. So it's really kind of set up for more of a bearish move here. That's negative indicator was really low, but now it's above 25, even if the positive hasn't dropped that far yet. We've still got a very strong trend developing, though it's not mature strength anymore, and you are below that blue line. I'm looking at the RSI on the CCI, and you can see you are breaking below the 50 and breaking below the 100 level on the CCI. So it's pretty bearish from that perspective. Looking at the Keltner channels and the Bollinger bandwidth, which is really, really high. The bandwidth itself is really high. So we're still open to pretty wild moves, and the bandwidth is that high there. We're not in the upper half of the range anymore. You can see the momentum is declining as the bandwidth moves back down towards. So you can kind of see, we had a pretty decent sized bandwidth over here, and then we just turned around and filled in the bandwidth to the downside, and it appears that we might be filling in that bandwidth is a pretty volatile move to the downside right now. That bandwidth at 37.66. When you look at the trade we did, we sold the 40 put and bought the 45. So we'd be getting back down to the lower end of the bandwidth, putting a half a position at normal, and then risk, trying to get about a 3-to-1 reward to risk ratio, knowing that pretty decent chance if we were to bounce back up, we can take obviously far less than the $540 loss if it's not working as expected, as we expected it to. All right, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow us on Twitter and Facebook, LinkedIn. Like our posts there. And have a great rest of your weekend, everybody. And we'll see you all on Monday.